Finance Core, Topic 5, NPV, IRR, and other investment measures. Readings include Chapter 7, NPV and other investment rules. And our learning objectives, we're going to compute the unlevered free cash flows for a project. We're then, number 2, we're going to compute some common measures of project return. We'll then compute equity cash flows or levered cash flows. We'll compute the equivalent annual cash flow, and then we'll understand what measures are used in practice to decide which investments a core organization chooses. So let's start with learning objective number 1. We're going to compute investment after-tax unlevered cash flows, FCFF. So here's the investment I'm thinking about doing. So I buy this boat, $159,900 from Stone Harbor, New Jersey, and I run charters over the summer. Since I'm only on a 9-month contract, why not, right? So here are my assumptions. I'm going to run this charter for 8 years. However, the depreciation of the boat is over 10 years. I'm going to do a straight line depreciation. In other words, I'm going to recognize 1/10 of the boat's cost each year in depreciation. At the end of the 8th year, I estimate that that boat is worth $50,000 based on boat sales of that age when I go to sell it. I'm going to go for 8 seasons. Each season is 16 weeks. I'm going to run 7 charters a week. That's 112 charters in a season. I'm going to charge $500 per charter. The operational expenditures per charter is $150. That's basically bait and tackle, and maybe hire somebody to help me out. And then per season, some operational expenditures. I'm going to pay $1,000 in insurance per season. I'm going to pay a docking fee of $1,600 per season. My tax rate is going to be 25%, and I'm going to need some working capital. So what I envision is to run this charter, immediately I need to put some money into an account, some cash that's not going to earn any interest, and I'm going to use that to kind of pay off my debts or my operational expenditures as they come due. Also, I'm going to have to buy some equipment that I'll need right up front. So I'm going to start the net working capital right away, period 0. That means today, and it's going to be based on next year's sales or that year's sales. So here's my model. This is my spreadsheet for my model. Let's go ahead and work on it. So again, period 0 means today. Period 1 means 1 year from today, and we'll just assume all the cash flows happen at the end of the year. All right, just for simplicity. So I'm going to generate revenues of $500 per charter times 112 charters per season. That's $56,000. And for simplicity, I just won't assume any inflation in my expenses or revenues. And since I do it on both sides, I figure it doesn't hurt me too much. And when I say I do it both for revenues and expenses. So I'm going to generate $56,000 a year in revenue. My operational expenditures per charter is $150. I'm going to anchor that times my 112 charters per season, anchor that. So I got 16.8. I can make this a little bit bigger if that helps. Depreciation. I'm going to buy this boat. It's going to cost me $159,000. And I'm going to divide that by a straight line depreciation life of 10 years. So it's a $15,990 per season. My insurance costs, I just assumed that it's going to be $1,000 per season. My docking costs, and then I can get my EBIT. I'll take my revenue minus charter OPEX, which will include again fuel and bait, minus my depreciation, minus my insurance, minus my docking. So $20,610. I'll then calculate my taxes. I'll take my $20,000 times my tax rate, 25%, anchor the tax rate, and that's going to give me my EBIT after tax. EBIT minus my tax, $15,000 a season. I'm going to copy that across, and so it stays constant. And we can just check, make sure we're on track. All right, depreciation. Well, I'm trying to get to I'm trying to get to free cash flows to the firm, those unlevered free cash flows, so I'm not going to have any interest expense. I'll add that later as an assumption. What if I wanted to finance that boat? Right now, I'm assuming I'm going to finance that boat with cash. So I'm going to add back depreciation because that is a non-cash expense. I'm going to subtract CapEx. Well, CapEx actually going to buy the boat today, so I'm going to put that there today. And let's go ahead and copy that depreciation over. And notice here where it says CapEx, it also has salvage. So I'm going to buy the boat today for $159, and I'm going to assume I sell it 8 years from today for $50,000. However, I'm not going to be able to keep the $50,000 because you have to pay taxes on the difference between what you sell it for, $50,000, and the value of the boat, the net book value of the boat, according to the IRS at the time of sale. So what I'm going to do is I'm going to focus on what does IRS say the cost basis of this boat is at the time of sale 8 years from now. Well, the cost basis immediately is $159.9. And then I'm going to take that number and then I'm going to subtract the depreciation. So at the end of the first year, the IRS considers that boat to have a value of $143. And if I copy that across, according to the IRS, that boat is worth $31,980 when I sell it. So the after-tax cash flow is I receive $50,000 and I pay taxes on the difference between $50,000 and $31,980. So I'll take the $50,000 and I'm going to subtract the tax rate times the difference between the $50,000 minus the $31,980. So I don't get to keep all $50,000. I'm going to be taxed on, what is that, about $8,000. I'll have a taxable gain. So I get to keep $45,495. That's my after-tax salvage. Salvage minus tax rate times salvage minus net book value. One thing I just want to mention at this point, according to the IRS, you are going to depreciate the full cost of the boat, not its useful life. I'm sorry, you're gonna depreciate the full cost of the boat, not the difference between the cost and the expected salvage. And so that's IRS rules. So that's why I am able to make these calculations. According to GAAP, you would actually depreciate the difference between the expected salvage and the cost. All right, so net working capital. The assumption is I'm going to need working capital equal to 10% of that year's full revenues. So I need to put $5,600 in an account today, and that account will then be used and replenished or maintained at $5,600 for the 7 years, and I'll use that to pay my expenses. However, at the end of the 8 years, I'm getting out of the business, so I'm going to liquidate that account, and it goes to zero. So a common assumption for a business that's going to end, a finite business, you're going to set working capital to zero in the finite or the terminal year. So again, think about this. The easiest way to think about this is cash I'm putting in an account that I use to pay bills. So I'm going to put that in an account today. So that's going to be an outflow out of my pocket. And it's just going to maintain that level. And then, however, at the end of it, when I sell the boat and I'm out of the business, I'm then just going to take that money and put it back in my pocket. So let's see what the net working capital is. And immediately it's going to cost me $5,600. And then I'm going to subtract the change in net working capital. And since I'm just maintaining a level of $5,600, there's no change until I get to the last year. And then the $5,600 comes back to me. So there's my net working capital per year. Now I can get my free cash flows to the firm. I'm going to sum up all the numbers from 9 down to 12. So my initial outlay is the cost of the boat plus that working capital. And then I start making some money. So my free cash flows, unlevered free cash flows, or free cash flows of the firm per year, about $31,005. And then I sell the boat in the last year. So these are my free cash flows to the firm. Since I'm down here, I might as well just add up my total book value of assets. And there we have it. These are the free cash flows generated by this project. The next section we'll talk about, well, how do I summarize these numbers. I don't want to just add them up. All right, can't add up number values of different time periods. So let's move on to the next topic, and we'll try to summarize those free cash flows and come up with a measure which will allow me to decide, do I do this project?